Welcome, everyone. Thank you for everyone that took the time to join our call today. And thank you especially to our presenters for taking the time out of their busy schedule to join us here and share their expertise with us. I will start by introducing our guest speakers in a minute here, and then I'll hand it off to you guys after introductions. My name is Felina Fleck. I'm the Assistant Director of the Graduate and International Programs Office here at San Diego School of Law, and we're so excited to be hosting this talk today. All of our presenters are from Chamberlain Herzliya, and I will start with introducing two of them that have already joined us, and one will join us in a little bit. I will start off with Roberto Perez Teuffer, the International Tax Compliance Manager at Chamberlain. Roberto is part of Chamberlain's international tax practice, where he advises multinational individuals and families on cross-border transactions, international estate, and tax planning. He also assists a wide range of international clients with cross-border business operations in complying with their tax obligations and tax-related planning. Mr. Perez Teuffer holds a law degree from Universidad Anáhuac, a master's in banking and financial law from Universidad Panamericana, and an LLM in taxation from our very own University of San Diego School of Law. He also completed postgraduate studies in the prevention of money laundering and the financing of terrorism at ITAM in Mexico. Next, we are joined by Luz Villegas Bañuelos. She is an associate of the International Tax Practice of Chamberlain's office in San Antonio. She assists multinational individuals and families with a wide range of international and U.S. tax law issues, including pre-immigration planning, expatriation, as well as international estate and tax planning. She assists clients with disputes in different government taxing agencies, such as the IRS here in the US. She earned her law degree from CETIS Universidad in her home city in Mexicali, Baja California, with highest honors. She also received her JD degree from our very own University of San Diego School of Law, cum laude, and an LLM degree in taxation from us as well. And then in a minute, Anwar Estefan will be joining us. He is a senior counsel at Chamberlain. His practice focuses on the international tax consequences of cross-border investments in the planning, transactional, and controversy context. Mr. Estefan has broad experience with international tax planning, controversy, and compliance, and commonly advises clients on a variety of U.S. international tax issues, including the application of U.S. anti-deferral regimes, foreign tax credit planning, and tax treaty planning. He has successfully represented clients in audits before federal and state tax authorities and in litigation in tax court. We have three incredibly great experts in taxation law here with us, as we can hear, and thank you to all two and soon three of you for being here today and donating your time and expertise to the group. I will hand it off to our presenters now to share their valuable insights with us, and if any of you in the audience are interested in following their footsteps with an LLM in taxation from the University of San Diego School of Law, I will provide some more information on that at the end. Lutz, Roberto, I'll hand it off to you now.
Thank you, Colin. Luz, do you mind sharing the presentation?
Yes. Give me 1 second.
Well,
And I think it's worth asking before we start, if any of you in the call have any background on international tax. Maybe some, no, not at all. Just so we know if we need to be more, to go back to the basic general explanations and then go into more detailed analysis. But okay, so we'll assume that most people here don't have a lot of background in international tax.
Yes, please, for me.
All right.
thank you. Well,
Okay.
good afternoon, everyone. We're very pleased to be with you today, and I'd like to thank Felin and the University of San Diego School of Law for inviting us to this talk this afternoon. as the title of this presentation suggests, we'll be discussing certain tax-related considerations under the current administration, specifically focusing on the so-called sunset provisions. These are key elements of the Tax Cuts and Jobs Act, which is the tax reform passed during the previous President Trump administration. And some of these provisions are set to expire on December 31st of this year. So it's important to have them in mind for certain planning opportunities and to provide precise advice to our clients. In addition, Anwar will discuss certain planning opportunities arising from the imposition of tariffs that you have all heard in the news in the past weeks. So this Tax Cuts and Jobs Act was passed by a Republican majority Congress in 2017 and represented one of the biggest, most ambitious tax reforms in nearly 3 or 4 decades in the United States. And among other things, it reduced the corporate tax rate to 21%. And some other big issues, like it capped the state and local tax deductions to $10,000, and it doubled the standard deduction, expanded the child tax credit, and all of these provisions should sound familiar even if you didn't have a background in tax or in international tax, since we all file our tax returns each year, and these credits are important to all of us. So the main purpose or the aim of this reform was to stimulate economic growth and create a more business-friendly environment in the US. And however, as mentioned before, some of these provisions are set to expire at the end of this year. And there has been some discussions around the possibility of extending these provisions since President Trump is now in office again. And that said, an extension of these so-called sunset provisions will require both a viable funding source, which is the most important aspect, and obviously the necessary votes in Congress. But we'll have to wait and see how this develops, and in the meantime, we need to have all of these provisions in mind, as we mentioned. Let's begin with the first provision in our list, that it's the state and tax exemption reduction. So the current federal state exemption amount is over 13 million per decedent. And in 2026, this amount is scheduled to be reduced to 5 million. Again, these amounts are adjusted by inflation annually. So this 5 million would be approximately 7 million. So what does this mean? So any decedent that passes with over $13 million in his estate would be taxable at a 40% rate. And if this individual is filing joint returns, this exclusion doubles to 26 or around 26 billion.
And just as a matter of, sorry, Robert, just as a matter of background, to understand how big this is, let's say about 15 years ago, this exclusion was about $1 million. So any estate that was worth over $1 million was being taxed. And I don't want to misspeak here, but I think it was over 40%. Right now, the tax rate would be 40% on the excess of this exclusion. But back then, the rate was up to 50%, even 60% at some point. So just to understand how big of a tax break this is, to have this exclusion go all the way up to 13.6 million, and even double for married couples.
Right. Thank you, Luz. And it is very important in the international tax arena to differentiate from US citizens and individuals that are domiciled in the US from those who are not domiciled in the US for estate tax purposes. Since domiciled individuals, as we discussed, have a 13 million exclusion, while non-domiciled individuals have only a $60,000 exclusion with respect to their U.S. situated assets. Now, when discussing the types of assets subject to U.S. estate tax, we need to have always in mind this aspect to know and determine whether the individual is domiciled or not, right? As you all may know, an individual is considered to be domiciled for this tax, for estate tax purposes, if an individual is physically present in the US and has the intent to stay in the country indefinitely, right? It's not a matter of immigration. It doesn't matter if the individual have a B1, B2, or tourist visa, or if it has a work visa. So the immigration status, it's not relevant. This is a subjective standard, and various factors are taken into account. We wouldn't have time to discuss in detail each factor, but it's basically based on the individual's intent to stay in the US for the foreseeable future, right? So as you can see, I'm sorry.
The one situation where it matters your immigration or your status is if you're a U.S. citizen, you will always be you domiciled in the U.S.
That's a good observation. Thank you, Luz. So the worldwide assets, as you can see in this table, the worldwide assets of a U.S. citizen or an individual domiciled in the United States are subject to estate tax. So anything over the $13 million we were discussing will be taxed. In contrast, for non-domiciled individuals, they will only be subject to estate tax on their U.S. status assets. These assets can include real estate, tangible property such as artwork, cars, yearly intangible property, including patents, trademarks, copyrights, and shares in U.S. corporations. So, and one important consideration is that U.S. bank accounts that hold only cash, not investment portfolios, no stocks, and life insurance policies are excluded from the state tax for non-domiciled individuals. At this point, somebody has any question? Or Luz, do you want to make any other comment about this?
No, I think this is just to make a point. This is one of the provisions that are set to sunset that, well, one, the current administration has presented and run a campaign saying that they will try or they will maintain this provision and avoid the sunset of this provision. Of course, until Congress actually changes the law, that is not the case, and it's set to expire. But it is important, but because if it is going to expire, it provides a great opportunity of planning for high net worth individuals, especially individuals that have 13.6 million, or married couples that have 26 million in their taxable estate, or of course more than that, because they could gift and use this high exemption before the end of the year. And then if it goes to half of it, like Roberto was explaining at the beginning of next year, they already used the bigger exemption and they benefited from it. So if it does go down to half and the provision actually sunsets at the end of the year, like it's set to do, this year is a great moment for planning and to make, and we won't get into too like technical details, but to make completed gifts and use this exception. Of course, it takes a lot of conversations with clients and to make sure that they're willing to actually give away their assets up to the value of the exception. But it is a great time to plan and use that exception. And then if you use it and the provision doesn't sunset, then next year they'll have a little bit more to use, and there's really not a bad result in that scenario, unless the estate tax goes away completely, then different scenario, right? That different world, but that it's just to understand that there's a lot of planning opportunities this year based on this provision.
Yeah, and just a quick note on that. So this exclusion amount is available for both gift and state taxes, right? So that's why you can take advantage of these provisions before they expire and gift whatever is over 13 million in your state, whoever you like, and take advantage of this huge exclusion amount that we have available. So before it was doubled with this TCJA reform, the 5 million, it was the exclusion amount was 5 million, and this was a record amount. So before, as Luz mentioned, it was 1 million. Then under President Obama's administration, it was changed to 5 million, and this was a record amount. So having 13 million or 26 million now available to gift or as an exclusion of your state is a huge opportunity or a huge planning opportunity. Right? I don't know if someone has any question or we should continue. Perfect. So on another front, marginal tax rates for individuals are set to increase starting next year. And this obviously affects not only in the international tax area, but to all of us who file taxes in the US. So rates will revert to their pre-reform levels. This includes an increase in the top rate from 37% to 39.6%. Obviously, Democrats have expressed support for raising the top rate again, while Republicans have favored maintaining or further lowering this rate. So we'll have to see what happens as well throughout the year. Luz, any comment on this? So additionally, there is another provision that will expire. We have a deduction. This is a bit more complicated than the other, called Foreign Derived Intangible Income, or FDII deduction. And this deduction will also be reduced. So as a result of the tax reform of 2017, Congress added Section 250 to the Internal Revenue Code, which introduced this deduction. This provision, in general terms, provides an incentive to domestic corporations, to C corporations, in the form of a lower tax rate on income derived either from tangible or intangible products and services in foreign markets. So currently, corporations can claim 37.5% deduction, resulting in a permanent benefit and an effective tax rate of 13.12% compared to the 21% corporate tax rate. So this is a huge benefit as well that would be expiring soon if these sunset provisions continue as they are. And the resulting effective tax rate, so the deduction would not disappear, it's only going to be reduced, and the effective tax rate starting or beginning January 1st, 2026 is 16.4%.
Thank you, Robert. And I know Anwar is here too, so Anwar, if you have any comments, please jump in.
Yeah, perhaps
as
to
well.
add a little bit of context. Is everybody familiar with the foreign derived intangible income deduction?
No, so we discussed at the beginning of the talk that most of the participants do not have like a international tax background.
Excellent. Okay, so very generally, what the foreign derived intangible income deduction was designed to incentivize was for domestic corporations to repatriate all of their intangibles, valuable intangibles that create profits, back to the United States to domestic corporations holding or owning those intangibles and licensing the intangible worldwide to its own subsidiaries or to third-party entities. The sort of the carrot, right? We talk about a carrot and a stick. The price or the incentive to bring back your intangibles was a lower corporate income tax rate on foreign derived intangible income, meaning any income associated with the exploitation of an intangible asset by a domestic corporation to the extent that the income at issue is sourced outside of the United States. So think of a royalty paid to a domestic corporation by a foreign entity. That royalty would be taxable at the general 21% rate, but for the foreign derived intangible income deduction, that effectively reduces the effective tax rate on intangible income to 13.125%. This, of course, was a great incentive for domestic or worldwide enterprises that are US owned to bring back intangible assets that were held outside of the United States for many reasons, including for tax reasons. Of course, this reduced tax rate or this reduced effective tax rate was temporary and was designed to last from 2017 until 2025. If this reduced or this provision, section 250 of the code, is not made permanent, it will essentially cause or will translate into an increase of income that is classified as foreign derived intangible income. Very importantly, and this is something that you should keep in mind, the definition of foreign derived intangible income is not limited per se to intangible items of income, meaning it is not limited to royalties arising from the license of intellectual property. It includes that, but it also includes profits arising from the sale of inventory outside of the US. So think of a US-based corporation exporting its products outside of the United States. That is classified for this limited purpose as foreign derived intangible income, as well as services. Services performed by a domestic corporation for use or for the benefit of a foreign client outside of the United States is also classified for this purpose as a foreign derived intangible, income. So keep in mind that when, for example, assisting a client in structuring a business that is going to derive some of its revenue from outside of the US, it would be very attractive to perhaps think of isolating the activities that relate to earnings and profits from the exploitation of intangibles, the performance of services, or the sale of inventory outside of the US in a single and independent corporation that can benefit greatly from this reduced tax rate, which again, if it's not made permanent, will extend or will be increased after 2025.
Then on that same line, another provision that was included in the TCJA was the global intangible low taxed income, or GILTI. We have a lot of words like this in international tax. So the purpose of this GILTI was to avoid or reduce the amount of US companies or global companies that would switch their taxable income to a low tax jurisdiction and avoid or maintain it abroad so that it wouldn't pay tax in the US until it was repatriated eventually when needed. So what this does, it basically accelerates the repatriation of income abroad in low tax jurisdictions. And I won't get into much detail because I want Anwar to have enough time to talk about tariffs. I know that's a very hot topic right now, but it's just important to know what GILTI does is accelerate the tax of income, even income that has not been actually distributed to US shareholders. So you can be a US shareholder of what we call a CFC, a controlled foreign corporation, that is not receiving distributions from this foreign corporation, but still has to include some income or certain type of income when reporting and paying taxes in the US, just to put it in a very simple way. And there's a deduction just like the one Roberto and Anwar were explaining that was in effect under the TCJA that is going to be reduced from 50% to a 10.5% tax on GILTI income. And then other provisions that are going to sunset that are not necessarily, Anwar, do you have a
Yes.
comment?
If we could go back to GILTI, just because I think it's important for people to understand it a little bit better. So again, remember we spoke about a carrot and a stick. A carrot meaning is a price for or an incentive for US-based enterprises to hold its intangible assets in a domestic corporation, as opposed to shifting or transferring those assets to an offshore jurisdiction, in many cases, a low tax jurisdiction, right? At the same time, you have the stick. I'm going to charge a tax to US-based enterprises, US-owned companies that are deriving intangible income outside of the United States in what is known as a foreign, as a low tax jurisdiction. So again, think of a domestic corporation that decides to do business outside of the United States. Income earned from that business outside of the United States is generally not taxable in the United States until and unless a dividend is paid by the subsidiary to its corporate parent, right? And this assumes, of course, that the US shareholder is doing business in a foreign jurisdiction through the corporate, in the corporate form or through a corporate subsidiary, right? So again, general rule, we know that earnings and profits earned by a foreign corporation that is owned by a US individual or a US corporation, those profits, those foreign profits are not taxed in the United States until and unless a dividend is paid to its shareholder.
Absent this provision, yeah.
Absent this provision. That's a general rule. We have anti-deferral regimes, correct? Anti-deferral regimes are designed worldwide in all of the Western world to essentially subject to immediate US taxation earnings and profits that are earned by a subsidiary in certain circumstances. For example, think of a foreign subsidiary that is earning passive items of income, dividends, interest, capital gains, royalties, right? That income is taxed in the United States by way of an anti-deferral regime that is known as Subpart F. And that has existed in the United States in the code since the 70s. At the same time, or simultaneous with Subpart F, the Tax Cuts and Jobs Act incorporated the GILTI regime, or the Global Intangible Low Tax Income regime. What this regime did was it's subjected to taxation. All earnings and profits earned by a controlled foreign corporation, a subsidiary of a US-based enterprise, all earnings and profits, regardless of the types of earnings that the CFC, the Controlled Foreign Corporation, is earning, to the extent that those earnings are in excess of what is called a deemed tangible income return, meaning 10% of the foreign corporation's investments in tangible property, tangible depreciable property, right? So you have a foreign corporation that invests, say, 10 million in a foreign manufacturing facility. 10% of that 10 million investment in depreciable tangible property is 1 million, right? All income in excess of that million, that deemed tangible income return, is deemed guilty and is subject to immediate taxation in the United States at the US corporate level, at the US shareholder level, irrespective of dividend distributions. Meaning that the policy of GILTI is to tax earnings that are deemed associated with an intangible asset. The code allows a foreign corporation to earn up to 10% return on its investment on tangible depreciable property. Any excess return, any return in excess of 10% of depreciable tangible property gets taxed as GILTI. So how was the GILTI taxed? Again, at the corporate level for US corporations, GILTI is taxed as ordinary income, but domestic corporations are allowed a 50% deduction that essentially reduces the effective tax rate on GILTI to 10.5%. This deduction is set to increase after 2025, meaning that the effective
Decrease,
tax
right?
decrease, correct.
The deduction decreases, yeah.
The deduction decreases and the effective tax rate on GILTI, or global intangible low tax income, increases from 10.5% to 13.1%, right? It's highly complicated. Hopefully, I was able to explain it in a relatively simple manner, but that's exactly what's to occur after 2025. An increase on the effective tax rate on income earned by a foreign corporation that is owned by US shareholders, to the extent that it is classified, that foreign earnings are classified as global intangible low tax income.
And just to follow up on Anwar's and just to give a little bit more context, this all happened because US-owned companies abroad were making profits and maintaining those profits in those low tax jurisdictions, reinvesting or through very complicated structures, and those profits would never make it to the US and would never be taxed or would be taxed at lower amounts. So the purpose of this provision is to get it immediately repatriated and taxed, at least to the extent possible in the US. And then, well, I'll quickly go through these. A lot of these provisions that are set to sunset are not necessarily only applicable for international tax, but they do have some consequences or touch on international tax in one way or another. This opportunity zones referral ending is basically the TCJA provided for certain called opportunity zones when if you had capital gains that should have been taxed at a certain time, but you use those capital gains and reinvest them in these qualified opportunity funds, you could defer or potentially exclude and not pay any taxes on these capital gains. But they were very specific, and this election is only allowed up until the end of next year. You can still make, or whoever is making this investment can still make this election to defer those capital gains, the tax on those capital gains until they actually sell their or get a return on their investment of this qualified opportunity funds. Then the next one, it's a 199A deduction. This, of course, as you see here, it applies to non-resident aliens, which are non-residents that are operating or foreign companies that are operating in the US through flow-through entities or transparent entities, or generally sole proprietorships or partnerships. This provision also applies to just domestic entities, domestic flow-through entities that are owned by US citizens, perhaps. But what the TCJA did is just a deduction equal to 20% of the qualified business income if the flow-through entity qualifies as a qualified trade or business. And basically what it is a business that's not a specified trade or business, which is generally services business, where the reputation or the work of an individual is the one that creates the value of the business. Those are specified trade or businesses. Those have very specific rules, and it's a lot more complicated to get this deduction. And this deduction is set to expire at the end of this year. So what the consequence will be is that businesses that were using this deduction since TCJA was enacted until now will just get that 20% will get taxed as an ordinary income, which would be up to, like Roberto was saying, if the rates go up, then up to 39.6% for individuals.
This is relevant when you are advising, for example, a client in a choice of entity issue. Your client wants to know whether to do business as a partnership or as a C Corp. With the lower 21% corporate rate that was enacted with the Tax Cuts and Jobs Act, it became a little bit more attractive to do business in a corporate form, just because of the reduced corporate rate. However, once you take into account the two levels of taxation, corporate income tax plus tax to the shareholders upon a dividend distribution, the effective tax rates on earnings and profits when doing business in the corporate form was still higher than doing business in the partnership or sole proprietorship form. With the immediate effect of the expiration of this deduction will be that the effective tax rate on partnership income will get increased. So again, the effective tax rate will continue to be less when choosing the partnership form of doing business, but it will perhaps tilt the balance towards doing business in the corporate form, especially in the context of an inbound investment by a foreign company. I think by far doing business in the United States in the corporate form is way more advisable than the partnership form. More or less so once this 199 TAPE deduction expires.
And I was just gonna add, Anwar, let me know what you think, but also reporting wise, it's usually a lot easier and cleaner to have a C Corp that's reporting and filing their tax returns in the US as a foreign owned company that's operating, talking about like an operating business. And then just lastly, before we move to tariffs, just this bonus depreciation, of course, it touches on the international context, but it's a domestic provision. The TCJA temporarily allowed for 100% bonus depreciation on certain assets, for example, tractor trailers, where like these companies were able to expense 100% of the trailers they were buying. For talking, for example, about transportation businesses, the year that they were acquiring these assets. Now this at the end of 2026, and this provision will not be available anymore, and then they will go back to depreciating these assets over the years. So the benefit of the depreciation will certainly be reduced. So that's important. There's a lot of cross-border businesses that use this kind of depreciation.
Exactly. From an international point of view, one of the requirements for bonus depreciation is that the asset purchase be placed in use or be put in use within the United States. Bonus depreciation did not apply. It has never applied for assets placed in service outside of the United States. Again, if you think of it from a policy perspective, the reason why this rule exists is to incentivize companies to reinvest or realign their productive processes by investing in the United States, as opposed to investing capital in manufacturing facilities or tangible property outside of the United States.
Unless there are any questions on these, I think Anwar, we should have about 10 minutes if you want to talk about tariffs and the potential planning opportunities that the US that we're going to have in the US.
Yes, certainly. If I could share my screen.
Yeah,
be
I'll
great.
stop sharing my.
So very generally, and again, I'm not a customs attorney. I just know enough to as anybody could really know about the topic. What I've been studying it in the context of international tax planning and planning options for multinational enterprises. And for context, as of today, we have a worldwide 10% tariff on goods produced everywhere in the world, from every jurisdiction or every country. So any export from Spain, Brazil, Colombia, any jurisdiction you can think of is subject to a 10% tariff when imported into the United States. We also have the special tariffs imposed under the International Economic Powers Act that on Chinese imports into the United States, that is 125%. In the context, which is what I do in my practice mostly, of Mexico and Canada, we have a 25% tariff in place, but that exclusively applies for or to imports from Mexico or Canada into the United States that are non-compliant with the NAFTA rules of origin. So think of so compare this, right? Think of tomatoes, avocados, any agricultural produce that is exported from Mexico to the United States. That product is NAFTA compliant or USMCA compliant and is not subject to tariffs. Compare that to a more complicated product that is assembled in Mexico, but with components from China, Taiwan, and any other country you can think of. If the productive process that is taking place in Mexico is not sufficient to satisfy the rule of origin provided or established in the USMCA, that import, although coming from Mexico, will be subject to a 25% tariff. So that's where it becomes very interesting from an international tax perspective, and hopefully you can make sense of all these rules by just looking at this diagram, right? So say that you have a Mexican-owned enterprise. It could very well be a Spanish-owned enterprise. Think of a Spanish wine producers that sells wine into the United States. Or think of a Brazilian-owned enterprise that sells any product you can think of made in Brazil into the United States. Again, on a first sale for export, so you could have the foreign enterprise. In this case, it's a Mexican enterprise, but it could be, again, a company anywhere in the world, except China. But it could be a company operating and owned in any other country, in any country of the world. And it could essentially create a business model where it sells its product directly to the US consumers, its US consumers, perhaps an independent distributor or unrelated distributors in the US, right? And all of the profit would be, of course, made at the foreign countries' corporate level, right? But what if, and this was published in Tax Notes. I'll circulate it after the conference, after the class, so that you can review it in your own time. But what if, because of tariffs, the foreign enterprise creates its own US full-fledged distributor? What is a US full-fledged distributor? Can anybody think of what a full-fledged distributor is? It's not a tax term. Any idea? So think of a distributor that assumes all risks and managing functions and business functions associated with the sale of the product in the United States, right? All of the relevant risks of the enterprise are assumed by the full-fledged distributor and not by the foreign enterprise that manufactures the product. So again, you have a foreign enterprise selling its product to a full-fledged distributor. The sale from the foreign enterprise to the US distributor is at cost plus a very low margin, and the largest margin is made by the US full-fledged distributor. Why? Because it is assuming the greater risks. Of course, that will allow the enterprise as a whole to mitigate the effect of tariffs, just because the sale from the Mexican enterprise to its full-fledged distributor would be at a lower value for customs purposes, while the bigger profit is made by the US distributor and would be subject to tax in the United States at a 21% rate. Upon a dividend distribution with the right corporate structure, when the US subsidiary pays a dividend to its holding entity, that dividend could be subject to a reduced rate of withholding if you have a treaty, right? So if it's a Mexican-owned enterprise, if it's a Chilean-owned enterprise, if it's a Spanish-owned enterprise, if it's a German-owned enterprise, if it's a UK-owned enterprise, all jurisdictions that have treaties with the United States that reduce withholding taxes on dividends, that would allow the company or the enterprise to mitigate or entirely reduce the adverse effect of tariffs, remaining competitive in the US marketplace, right? So again, the main idea being first sale for export at cost plus a very low margin, US full-fledged distributor, foreign owned by the foreign enterprise, will be making the larger profit, would be paying tax in the United States. And upon a dividend distribution, that dividend should not be taxed again in the United States, or maybe subject to a reduced rate of withholding if we have a treaty in place. Of course, many foreign jurisdictions, that's the case of Mexico and pretty much any other European any jurisdiction in Europe, for example, allows its own enterprises to for an indirect foreign tax credit, meaning the foreign enterprise can credit the tax paid at the US corporate level, at the US subsidiary level, plus any tax that was withheld on distribution by reason of a dividend. So again, this is in an article that was published in Tax Notes. It's a model that we've been working with clients, and hopefully you'll find it interesting. But I think it's, for the context of this discussion, I think it's interesting for you guys so that you can see a little bit, or appreciate a few of the international tax rules that we deal with often.
Thank you, Anwar. Do you have a link you can add to the chat so that anyone who's interested can access this article at a later time?
And then if you guys don't mind, I'll just finish with saying that we're probably gonna see some changes in some of what, well, or a lot of changes, we don't know. And some of the items we've talked about today in the next few months, especially as Congress is discussing a potential reform or a bill that may or may not include some of the tax provisions we have been discussing. So just keep an eye out on any changes. Maybe all of the provisions we talked about are gonna sunset at the end of the year next year if nothing changes, but there's a possibility that they do. And then on Anwar's topic, I know there's renegotiation of the USMCA potentially next year. So that's another thing to keep in mind that may change the consequences on the US and the taxes and tariffs and everything that those impact. But I don't know, Anwar, Roberto, you have anything else?
No, I think we're a little bit over the time, but thank you so much for all of you who attended. And Anwar just shared the article in the chat. It's a PDF, so if anyone's interested, they can download it. And thank you, Feline, Robin, and Karen for having us. It was a pleasure.
Thank you. Thank you so much for your time and dedicating this hour to us. I wanted to share my screen quickly as we wrap up here. For anyone that is interested in our LLM in US, in tax law here in the US. We have our new online program launching this fall, completely online LLM and taxation that you can do from anywhere. We also have our top 10 ranked on-campus program here, just as we have for many years. If you're ever interested in that or know of anyone that might be interested, such as Lutz and Roberto have done, feel free to share any information. thank you so much for everyone who attended and to the presenters. And if there are no further questions, I wish everyone a great day.
Thank you, everyone.
Thank you, everyone.
Thank you.
Good afternoon. Bye, Karen.
Thank you.
Thank you.